My name is David Etienne of Etienne Business Solutions, certified public accountant. Today I would want us to take a look at what is referred to as diversification, but more specific to investment opportunities. So you may hear talk of portfolio, investment portfolio, and along with that term comes the phrase diversification. So we're going to spend some time looking at your diversifying your portfolio. Fancy term, but a simple concept. Simple concept. As an investor, you'd want to put your resources in different places. So there's a saying, I do not want to put all my eggs in one basket. Why? If that basket should suffer some mishap, all my eggs will be broken. Simple principle, it applies to investments also. So you will find that quite often investors want to spread their funds over different investment opportunities. Because as it is, and this is just how investments work, where depending on market conditions, some investments will suffer badly, some will do well, some will hold stable. That's just how it works. So if you have a diversified portfolio, you have invested in a number of different types of securities and assets, what it means is that we're going through a period where asset A, property B, security C maybe experiencing or suffering from a downturn in the market, you may find that other things are happening. For example, right now, as we know, then the people who are in the oil and gas industry are having windfalls. So a diversified portfolio is one where you have invested or you have utilized your resources by putting them in different types of properties, type of investment opportunities, and maybe too, which is more often the case, in different sectors. The mining sector, the travel industry, the entertainment industry, the food sector, you name it, okay, medical services. So you do that so that you're thinking that where certain investments are suffering from market conditions, others may be doing better. And as a result of that, I will end up with a balanced situation where the gains on one side will help to offset the downturn on the other assets, the other securities, the other investments that I'm carrying. So quite often you hear people talk about diversification of your portfolio, and that's a wise way to go because you really want to spread your resources in a manner that will help you to minimize the overall risk of your pool of funds that you have put into investment. Okay, so now back to earlier on I was speaking about capital gains, unrealized versus realized capital gains, etc. Now let us say in a particular year some of your investments have suffered some level of capital loss, and you have liquidated those investments, and so you have realized those losses. So those were bought at 100,000, they now value 80,000. You dispose of them, and so you have realized a loss of $20,000. Let's also assume that on the other hand, you have some other properties, some other investments that did well. And those, when sold, give you a profit, a gain, a capital gain of 50,000. So on one side, you have made a capital gain of 50,000. On the other side, you have suffered a capital loss of say 20,000. Because of that balancing scenario, you're going to find that you would not have to be considering capital gains tax on the full 50,000 gain because you are allowed to use the 20,000 capital loss to offset or to balance against the 50,000 capital gains. So 50,000 capital gains, 20,000 capital loss. It means therefore once we put everything together, we're looking at a 30,000 capital gains, and that is the figure on which we would need to contend with capital gains tax. So you see, the right away you're allowed to reduce your capital gains to the extent that you have incurred capital losses. Now this is where capital gains is used, or some capital losses is used to offset some of your capital gains. As a result of that, you end up with a lower figure that is subject to capital gains tax. Let's revise the illustration. What if I made 50,000 capital gains, and yes, I made 20,000 capital loss, and so I offset my 20,000 loss against my 50,000 gain, and so I am only looking at a 30,000 capital gains that would normally be subjected to capital gains tax. But when I look at my overall tax picture, if I have other income, follow me now, if I have other income that would normally be subject to taxes, then the unutilized capital, follow me, the unutilized loss can be applied to those profits. So let me turn the numbers around. So let us say that I have a whopping $30,000. I'm just switching the numbers so that I can show you how the other income can come into the whole equation of how we benefit from that capital gain, capital loss scenario. Okay, so you have accumulated X amount of capital loss, and I'm switching the numbers. Let us say that we had $50,000 capital loss, but we only had 20,000 capital gains. It means therefore that when I put everything together, my 50,000 capital loss was able to totally wipe out the 20,000 capital gains. Cool. But then it still leaves me with a 30,000 capital loss that I have holding on to. I'll just repeat that example so we're clear. I have switched the numbers and I'm saying we now have 50,000 capital loss, 20,000 capital gains. That 50,000 capital loss is able to wipe out the total 20,000 capital gain, and so I will not have any capital gains tax on the 20 because I have more loss than I have gain. But even after applying the 50,000 to the 20 and getting rid of that 20,000 capital gain, I'm still holding on to 30,000 capital loss that I cannot apply to any capital gains because I've already wiped out the 20,000. But all is not lost, because if in that year I also have income, other income, taxable income that would be subject to taxes, then I am able to use some of that 30,000 unutilized capital loss to offset, up to an extent, the tax impact that I would have suffered on those other income. And I am allowed up to $3,000 to offset any tax bill on ordinary income up to $3,000. So it means that of that 30,000 unused capital loss, I can use 3,000 of that to further reduce my tax bill that arose from ordinary taxable income. There's still 27,000 that can always be taken forward to future years, where if next year and the year after I now have some other capital gains, then I have a 27,000 capital loss unutilized that I can keep applying to those future gains, those gains of future years. So it is possible that I will have realized capital gains for the next 2, 3, 4 years and yet never have any capital gains tax to pay. Why? Because I have this stock of capital loss that was not utilized and that I keep applying to those gains year after year after year. And if I do not have future, or if next year and the year after I do not have additional or new capital gains against which to offset the capital loss, I may continue having taxable ordinary income. And so I'm able therefore to apply 3,000 next year, 3,000 the following year, etc., etc. Important to note that if in future years I end up with capital gains, then there's no limitation on how much of that capital loss carried forward that I can apply to the gain. Okay, if that gain in future years is greater than that 27,000 that I'm carrying forward, I can apply all of it. So the capital loss carried forward can be applied to any future year's capital gain without any limitation. Well, the only limitation is that you can only use the maximum of the capital loss that you have carrying forward. But if there are no capital gains against which to apply the brought forward capital loss, and you have taxable ordinary income, you're not allowed to just apply any amount of the loss to it. You can only apply 3,000 of your carried forward capital loss to offset whatever tax you would have on your normal ordinary income. Very, very important to note. Okay, so I hope by now you're seeing the dynamics between this realized loss, unrealized loss, realized gain, unrealized gain, the treatment of each, and also how we apply them from year to year, and what are the provisions for gains and losses that, as it were, straddle multiple years. Bearing in mind too that if you have a capital loss carrying forward, remember now, unless you realize a capital gain in future years, there can be no offset, because you cannot use realized capital loss carried forward to reduce unrealized book or paper capital gains. Meaning that, yes, there are some gains, but you have not sold, you have not liquidated the asset to actually realize the gain. It is only a paper gain, so you cannot do that. Not that you'd be interested in doing it in any way, because you want to keep your loss for more real money, real tax bill. Okay, so again, that is something that we want to be very, very careful to note when it comes to capital loss, capital gains, the application of one against the other, the ramifications for when we have a carry forward balance, how we can utilize it, and we look at the utilization against future capital gains that are realized or future taxable ordinary income. Very important to know. Great. Again, I'll take a break, but we will look at something that that's very important in the whole scheme of things, and that is what we refer to as wash sales. You may have heard mention of a wash sales when it comes to trading in investment and in securities, a wash sales. So we'll be looking at wash sales.